How are inflation-linked bonds used in conjunction with options trading strategies? Have you ever wondered how inflation-linked bonds can work alongside options trading strategies? Let's break it down in a clear and straightforward way. Inflation-linked bonds, often referred to as ILBs, are designed to protect investors from inflation. They adjust their principal value and interest payments based on inflation indices, like the Consumer Price Index. This means that as inflation rises, so do the returns on these bonds, helping to preserve purchasing power. Now, when we talk about options trading, we are discussing contracts that give the buyer the right to buy or sell an underlying asset at a predetermined price before a specific date. Investors can use options to hedge against potential losses or to speculate on price movements. So, how do these two financial instruments work together? One key strategy is using ILBs to hedge against inflation risk. While ILBs provide a safeguard against rising prices, options can be employed to protect against potential declines in the bond's value or to speculate on changes in interest rates. This combination allows investors to manage their overall risk effectively. Another interesting approach is dynamic allocation. By combining ILBs with options, investors can adjust their portfolios based on market conditions. For instance, if inflation increases, the value of ILBs may rise. Investors can then use options to lock in gains or shield themselves from possible downturns. Constant proportion portfolio insurance strategies are another way to utilize ILBs and options together. This strategy involves allocating a portion of the portfolio to a riskier asset, like options, while the remainder goes to a safer asset, such as ILBs. The proportions can be adjusted based on market trends, allowing for flexibility. Interest rate changes also play a significant role. Since ILBs are linked to inflation, fluctuations in interest rates can impact their value. Options can help manage this risk by providing protection against rate changes or allowing investors to speculate on future movements. Practically speaking, ILBs offer direct protection against inflation, while options can help manage other risks associated with these bonds, such as interest rate fluctuations. Combining these two can enhance portfolio diversification, adding both inflation protection and flexibility in risk management. Incorporating inflation-linked bonds into a portfolio alongside options trading can provide a unique blend of stability and risk management. This approach allows investors to balance the steady income from fixed-income investments with the dynamic opportunities presented by options trading strategies.